UConn Foundation, we are excited for today's discussion on mastering your finances, strategies for a secure future. Today's presentation will feature three incredible alums in the financial field, as well as the department head of economics. Before we begin, here are a few areas of note to manage your webinar participation. First, there will be an opportunity to ask questions by typing them into the question box on your control panel. Please use the question box and not the chat. Your questions will be addressed at the end of the session. Secondly, a survey will be sent to you as a follow-up. So we would appreciate if you would fill out the survey, and we can continue to bring you the types of webinars that you are looking for to enhance your career. And lastly, this webinar will be recorded. Please visit our YouTube page at youtube.com/UConn alumni sometime later this week to review and view previously conducted presentations. Now, without further ado, I would like to introduce our moderator, Professor Richard Langlois.
Thank you, Jessica. My name is Richard Langlois. I'm the head of the Department of Economics at UConn. I've been at UConn since 1983. But I don't think you want to hear from me. I think you want to hear from our brilliant young alumni, and I'm going to first ask them to introduce themselves, and then we'll start with some questions about finances. Abby?
My name is Abby McClellan. I'm located in the Dallas area, and I graduated UConn in 2022 as a philosophy pre-law major, and then shifted my practice at Northwestern Mutual, and now I work as a second chair and have my own practice as a wealth management advisor at a firm called WWA with estate planning and overall financial planning and retirement planning.
Justin?
Awesome. Thanks. My name's Justin Wangwan. I graduated from UConn back in 2013, studied economics and business, and I am currently a managing director in Stamford, Connecticut at Northwestern Mutual, and our practice is called Physicians Nationwide.
Lucas.
Great. My name is Lucas Hannigan. I graduated UConn in 2018. I'm working for a company called Fiducian Advisors in Windsor, Connecticut, which is an institutional financial management company.
Great. So let's start out before we get into talking about heavy-duty investing and wealth management questions. So let's first ask some more basic questions about finance and budgeting. And Abby, why don't you start us off? So could you say a little bit about financial literacy, what it means to you, and how important it is today, and how would you define financial literacy given the financial climate today?
Yeah, so I think financial literacy, especially for me as someone starting out in the CLIS philosophy background, learning all the financial terms and, getting to know the financial realm, it can be a really intimidating. But I think really financial literacy is just staying up to date with what's going on in the economy, making sure that you're in a strategy that best fits your tolerance to financial literacy. If you're not someone watching, the news 24/7, making sure that you are in the strategy that's going to fit for you, and really just knowing your budgets, saving, and doing just starting today and doing the most you can to keep up on those pieces and knowing what that means to you and your world.
So especially alumni like you who've graduated fairly recently and probably new at thinking about budgeting and strategies for saving money and making ends meet. Do you have any tips that you might give to young people, recent graduates, about how to manage their money, how to create a realistic budget and stick to it, that sort of thing?
Yeah, I think the biggest thing with budgeting is a lot of times when we sit down to budget, we're thinking of what we would do in an ideal world. And I think we overly budget towards, goals and trying to make it look perfect on paper versus what our actual day-to-day life looks like. There's going to be larger expenses that we don't think of. And I think under budgeting is the biggest risk. I think being realistic about what you really can and can't do is going to keep you on track. Because if you allocate too much to goal funding or paying down debt and not to the things that you do in the day to day, going out for dinner, going to the movies, those types of things, shopping, if you're not being realistic of what that looks like for you, that's going to just deter you away from budgeting and sticking to it. So I think just starting with what is realistic for your day-to-day life and just starting doing it. So, if it's putting $20 away in savings a month, and that's all really you can do for now, if you start today, you're going to be better off than if you start, a year from now.
Justin or Lucas, anything you'd like to add to that about sort of tips for good habits uh, for financial budgeting and managing your finance?
Yeah, sure. I would say it's really important to start with a specific, clearly defined goal. I think, in today's era where financial decisions shape a lot of what we do, um, basics of budgeting and financial literacy empowers us to make just informed decisions, right? It helps us navigate complex financial landscapes, and secure overall financial well-being. So I would say start with a specific goal and accept that some risk will be necessary to reach those goals. Um, and make sure to have a long-term perspective. So those would be my tips.
Yeah, I'd also just say that consistency is an incredibly important habit to maintain because a budget isn't something that you set it and leave it alone. It's you have to continually revisit it, update it, make sure it fits with how your life is and your long-term goals. And something that I do and I personally recommend is I think automation is incredibly important. If you can automate savings and automate certain transaction, that saves a big headache for you, and it kind of forces you to stick to that budget, which is always nice.
To echo what Lucas was saying on automation, I 100% agree on that. And I think a good tip on that is doing it the day your paycheck hits or money hits so that you don't even see it. It just comes out and it's not in your spending control.
So one of the main things that all of you will want to or will have budgeted for is wealth management, that is investing for the future. I tell my students that right now you all have a giant debit on your balance sheet, and that giant debit is your retirement. And so you really need to start building up a credit to offset that giant retirement that's going to come when you get to be my age. Um, let's talk a little bit about wealth and investing, and I think that's maybe one of the more interesting things that people are interested in talking about. Justin, could you start us off? Somebody just starting an investment, what would you counsel them to do? What would be kind of the fundamental principles of investment that you would bring to people's attention?
Yeah, thanks, Richard, for the question. And I think it's again going back to what I said earlier. I think being consistent with keeping money aside each month is super important. And we're huge fans of being proponents of giving every dollar a job description. So it might be as simple as enrolling in your company's 401k plan with a match. Or, if you're within annual income guidelines, looking at things like Roth IRAs that are for, positioned for long-term retirement. But things as simple as, going on a Vanguard account or a Fidelity account just to get those habits in place now. Because really what we're trying to take advantage of is compounding interest. So.
What are some of the biggest myths or misconceptions that people have about investing?
Yeah, I think one of the common ones that we hear in our practice day to day is timing the market is being key to being successful. And I think time in the market beats market timing 100%. It sounds a little bit cliche, but through history, through the markets, it's been proven time and time again that there's never a perfect time to invest. I think it's statistically improbable to time the market because you probably wouldn't need Lucas, Abby, or myself in terms of guidance. But I think just getting going. So I think timing the market's a common one that we hear. But as I mentioned, time in the market is rewarded through compounding interest and protects investors against things like inflation, which is a huge concern in today's environment. I would say another one that we hear often is holding gold. Right? We get that a lot from clients where they're like, "Hey, what do you think about gold? And should I go buy a gold bar?" And so my feedback there is, although gold has been a popular way to store wealth for virtually thousands of years, gold does not offer a guaranteed protection against things like inflation, right? So although we look at money concepts from around 1980 to the present, they provide yield, right? But if money isn't compounding strategically in, let's say, a diversified portfolio, we're bigger proponents of having those funds in what we call equities or the stock market to beat against time in the market. So that would be the top two that I hear amongst retirees today, and also people that are looking to get into the market.
Are there any strategies outside of traditional investing that you would recommend, or do you recommend that people would stay away from that?
Yeah, so I think when people enter into the market, there seems to be a lot of enthusiasm around, growing wealth, but we tend to forget how to safeguard them. So we're big proponents of hedging risk, and I think a really good one, is real estate, for example, right? So outside of that traditional wealth building strategy, investing in rental properties might be a good alternative. There are some insurance programs in the marketplace that creates wealth and legacy outside of traditional investing. Another could be a real estate investment trust, right, which allows investors to fund multiple commercial properties, which offer higher yields and which may come with a management fee, but you can start taking advantage of, I would see those buckets as an addition to, as opposed to being mutually exclusive, or even just starting a business. And I think we see a lot of that today in our world, where people go and start big corporations and businesses, and there's a lot of savings to be had from just knowing how the tax code works. So those would be some concepts outside of traditional investing.
You raise the issue of risk, and so how should we think about risk in an investment portfolio, especially if we think about it over time? So how would you manage risk in an investment portfolio over time?
Yeah, great question, Richard. I think balancing risk and reward for investors, first and foremost, keeps us longer, right? We stay longer in the market, and by doing so, we get better returns. So one proven technique is diversification, right? So in the investment world, what we typically look at is, when we manage portfolios for clients, we're making sure that they're invested in different types of asset classes. So that might include stocks, it might include mutual funds, it might include gold, or government securities and other fixed income opportunities. And a concept that I would urge everyone to kind of look into is what we call the modern portfolio theory. So it was coined by Harry Markowitz, and he was a huge proponent of diversification and portfolio selection. So I think diversification is closely intertwined with market risk. And so if we're allocated in different sectors, different market exposures, chances are they're not all going to do bad on the same day. So
to echo something from what you were saying, Justin, on that, is overall, we like to look at all your assets on one sheet as your total asset mix. So if you've heard the term, 60-40, 70-30, 50-50 portfolio, that's your risk on to risk off in your total portfolio. So if you have more equity exposure, you're more risk on. If you have more bond exposure, you're more risk off. And so looking at all of your assets, including your business, your real estate, it's all on one sheet and one overall tolerance of, hey, I'm 60-40 in my overall asset allocation rather than just in the individual accounts, so that you're allocating those individual accounts according to what your risk tolerance is.
Mhm. This is moving us a little bit into thinking about retirement. Now, the conventional wisdom about retirement is that when you're young, you want to have a portfolio with more risk. You want to have maybe very heavy in equities, because historically the stock market has been really the only place that has outdone inflation historically, which is, of course, no guarantee that it will continue to do so, but the stock market has done that. And so if you're looking deeply into the future, you probably want to have a lot of equities, set it and forget it. But as you get closer to my age and you might want to start using those funds, you want to slowly shift your risk away from equities into fixed assets and T-bills and that sort of thing. Is that wisdom still current, would you say? Lucas, would you say that is the way that we should still think about it?
Yeah, I would agree. When it comes to the, financial strategy and long-term goal setting, I kind of tend to see things in about three buckets. There's the accumulation phase, the preservation phase, and the distribution phase. So, Richard, to your point, your the accumulation is the 20s and 30s. You can afford to take a lot more risk. You can afford to not really have a lot of fixed income or bond exposure to get that kind of inflated return. Once you hit your 40s and 50s, you got to start thinking about retirement. It's a weird thought, especially with something that could be 20 years out. But market cycles happen about every 10, 15 years. And, can you really stomach a 20, 30% drop? And something we talk about in our industry is, if you lose 50% of your portfolio value, you have to make 100% to get back to where you were before. So when you get to the, later stages of your career, you want to start moving more into fixed income to de-risk, to kind of smooth out the volatility profile of your portfolio, so you can still get that return of equities, but you don't have the ups and downs that come with a riskier portfolio.
Right. Although the people have been pointing out that people are living longer now, and so we don't want to think about 65 perhaps as retirement age anymore, but think about the possibility that at least the possibility I'm certainly hoping for, that one lives considerably longer than that. So there might be an argument for staying in equities um, um, even longer. Lucas, could you talk a little bit more about the kind of nitty-gritty of how people would say for retirement? What are the instruments? What are the kinds of funds that people might use?
Sure. Yeah, I guess I'll start with the basics. There's two essential kinds of retirement accounts. There's Roth and a traditional. These exist both in 401k, 403bs, IRAs. It varies depending on what kind of industry you're in. Traditional is made with pre-tax dollars, so you get a lower income to report on your taxes, which leads to a tax savings in the year. But the flip side is that you pay taxes on any gains that you would make. So when you take the money out, you get taxed on it. Roth is essentially the flips, where you make contributions on a post-tax basis, so you don't really get any tax benefits when you make the contributions, but all of your gains are tax-free, so you can withdraw it with no penalty. So this is good for younger people. I would always encourage a Roth approach, because when you start investing young, you have a lot of time on your side. So if you grow your portfolio to $1, $2, $3, $4 million, that's all tax-free.
And also, when you're young, you may have a low tax rate.
Absolutely. Yeah.
And you hedge that risk of income tax rates going up in the future and being higher when you're trying to take distributions out at retirement.
Right.
Also less to think about, I feel like. When you don't need to worry too much about the tax rates. If it's all tax-free, you can kind of plan around something like that.
Right. when you're in that middle phase that you were talking about, that tends to be when people are at their highest earning level. And so it's good to have some traditional 401ks, 403bs that are taking the income away from your taxable income then, and so lowering your tax obligations then when your tax rates are at their highest, right? So
Absolutely.
you want to get into Roths when you have a low tax rate, and you want to be in traditional IRAs and 403bs, et cetera, when you have a high tax rate.
It's also worth noting, I'm sure everyone is aware, but there are income limits on Roth accounts, so you can only make a certain amount of money and still contribute to Roths. So that's also a factor in that as well.
Right, right. Um, um, so maybe let's go back to the point I made about people living longer. If we have started to see inflation again. One thing that economists know is that you can't predict the future, which is the exact opposite of what people think economists know. Um, Economists are one of the few people who will admit that you can't predict the future, but we have seen an increase in inflation compared to what it had been when the Fed was keeping the interest rates low. Um, is equity? Do you agree with my proposition that holding equity is probably the best way to hedge inflation in the future, or would you advise adding things to the risky part of the portfolio? So you mentioned gold, you mentioned real estate. What do people think?
I think that equities is probably the the easiest option, I would say.
Hmm.
Mutual funds, well diversified portfolio.
Right.
To Justin's point, you can add gold and real estate, and I think there are real estate mutual funds and there are gold ETFs that track these markets, so
Hmm.
you can add that into your portfolio without necessarily owning a gold
Right.
bar. Um, but I think that as inflation ticks up and these things happen, these companies will by a byproduct make more money, they'll earn more revenue, they'll become more valuable companies, and by owning a piece of that, you will benefit from inflation even if prices go up on your end.
Right, right, right. That absolutely. I guess maybe we should clarify when we say investing in equities. I think it was Justin who made the point earlier that you don't want to pick individual stocks. What you want to do is invest in a diversified portfolio, and often the best way to do that is with a fund that tracks like the entire stock market. A typical thing might be an S&P 500 fund that owns stocks in every company in the Standard and Poor's 500, and you can even diversify beyond that rather than picking stocks. And so that's kind of the standard conventional wisdom. Um, put your money in a no load mutual fund and just leave it. Don't play with it. Maybe adjust it as your age changes, but don't adjust it for the market. Do you agree with that? Conventional wisdom is still what we should be telling people.
Yeah, Richard, absolutely. I think one thing to be aware of investing in anything is you should be aware of the expense ratios, the fees. Um, and so I think picking individual names, it's going back to that concept of trying to time the market. It's highly improbable because it might be doing good one day, but can we pick a specific day 5 years in advance where we know if that stock's going to do good or bad? And so going back to the mindset of a diversified portfolio that tracks every sector, every industry. Something that I think about too is low cost exchange traded funds as another alternative to that diversified approach. So I would say yes, absolutely, 100%. It minimizes risk, optimizes returns, and protects you on the fees that you might be paying.
Right.
I would say too, to add on to that, we've been in a really large equity boom for the last 17 years, and keeping some type of fixed income solution in your portfolio is important because, there's been points in history where fixed income has outperformed equities. And I would say within equities too, making sure that you're not just in those big S&P 500, the miraculous seven
Right.
big stocks, and making sure you have a good mix of growth and income stocks so that you're getting both those dividends and also the growth, just depending on how the market is moving.
Right. Funds are often divided into large cap and medium cap and small cap, meaning does it have all the big companies in it or does it have a lot of smaller companies in it? And the smaller companies often better represent the stock market as a whole. Because right now, the something like the S&P is dominated by the big seven companies who have phenomenal um, you know, phenomenal market capitalizations. And so in some ways, an S&P 500 is not as diversified as you might think because it's really heavily Apple and Amazon and Microsoft and all of that. So you might think about small cap funds as well or medium cap funds. Um, So we've just, I think, been talking about, I think Abby, you raised a good point about we're sort of in a period of economic uncertainty now, and it's interesting that there's been a lot of movement in individual stocks in the stock exchange, but the averages haven't been moving that much. They've been holding steady, declining a little bit, which is speaks to the volatility of the market right now, and all the more important the continued importance of diversification. Are there other ways that you might suggest that people could think of to respond to a period of economic uncertainty like the one we're facing now?
I think it's important to really keep a good cash reserve, whether that be in something like a money market, CDs, cash value life insurance, whatever that looks like, making sure that you do have that in your back pocket, because we could go into a period where bonds outperform equities,
Hmm.
and we want to make sure we're taking advantage of both sides of the market and filling all of our buckets so that down the line in retirement, we're kind of in this first generation that's really having to distribute their own retirement income, and they're not just receiving paychecks from pensions where it's a guaranteed
Right.
income forever. And so making sure you can, when the market is down, we're not having to take a discount on
Right.
our investments. We have that in our back pocket to really make
Right.
sure that we have that safety net.
Absolutely. Um, so let me raise an issue that everybody is interested in these times. What about artificial intelligence? Is that artificial intelligence going to change the way that we do investing? I guess there's two parts of that question. One is, I suppose, investing in artificial intelligence, but I think the more interesting question is, what role will artificial intelligence play in financial planning and in investing?
I think that not financial, artificial intelligence is similar. It will function similarly to the way that it does with other businesses, where it's a great tool to have. It's not something that I would personally rely on too heavily, since it can be fooled, it can be tricked, it's not perfect. Um, I don't know if it would impact things too heavily. Something we all have to think about is that, hedge funds, private equity funds, these complex financial institutions, they spend tons of money and time building out these AI generative models to predict stock prices. So AI has kind of already been in the financial world for
Mhm.
quite a while. So I don't think it's going to be this dramatic shift. I think if anything, it'll be a nice boost to retail investors, to your average everyday folk who are
Mhm.
saving for retirement. But I don't think it's going to be the end all be all.
I to echo off what Luca's saying, I completely agree with that. I think there's such an emotion to finance, investing, retirement planning, all of this. There's so much more than just numbers that go into how you plan for the future. Because at the end of the day, AI could do some of those trades and help with the investing, but people want to have someone that they can, call up and help with the asset location and where things are going to play out over time. Because allocation of investments is important, but where you're locating them, how you're pulling from each different bucket in your overall plan is just as important as allocation.
Yeah, and sharing the same sentiment as Lucas and Abby, the way we view AI is it's no different than any other tool that you would have access to. I think ultimately what it'll do for us and the investment world is it'll aid the analysis of vast amounts of data, right? So we look at structured information like financial statements, and you have the unstructured data points like the news or social media. And what it's going to help us do a lot better is just to extract actionable insights. But to Abby, I don't think robo or AI is going to replace the human element in a financial planning relationship.
Okay. So having discussed some of the investment stuff, maybe we should circle back to where we started, and think about budgeting and how to manage your money. And one way to think about that is, having the right kind of mindset to manage your money. Do you think there is a mindset that one should adopt in successful budgeting, that one should adopt in managing one's money?
I think that's a mindset is the most important thing about financial planning is how you're approaching it and how you're looking at it. And I think the most important part is just really knowing where you're at and knowing that it's not going to be perfect. A lot of people want to start financial planning when they're ready and have, the correct funds and the perfect timing, and they can sit down and, go through everything. But at the end of the day, there's really never going to be a perfect time. And the best time to start financial planning was yesterday. It's just doing what you can in your current situation and knowing where you're at and making sure that, you're just sticking to the consistency of those goals and having that goal in mind, like Justin was saying earlier, that you set that goal and you're just doing what you can today to get to it.
I also think it's important to think about that, budgeting and planning this out and being disciplined and structured with your money is difficult. It's something that we all have to do and kind of like put in intention to. But something else that's difficult is, living paycheck to paycheck and struggling and like they're not mutually exclusive. Like we kind of have to choose what our hard aspect is going to be of our lives. If we want to put the effort into, budgeting and saving, I think that's better than putting the effort into the other side of things.
Yeah, and something I would add is just to monitor spending habits, right? Avoid buying things you don't need. And an actionable item is we love to use the 50-30-20 rule as a baseline. So I would say if you were to carve out 50% of your savings and aggregate income towards things like necessities. So I think of gas, food, mortgage, rent, credit card payments. 30% should be delegated towards lifestyle choices, right? Gym membership, eating out, going out with friends. And the 20% should be on savings. So I think about 401ks, Roth IRAs, the S&P 500. And so I think just having structure and a routine and sticking with it is what's going to help us with that long-term perspective.
And there's a lot of apps out there that you can have on your phone that I use a lot, where it will just tell you when you're reaching the top of those goals. So you can allocate, certain amounts to each sector, eating out, towards grocery shopping, towards, savings, and it will send you alerts and say, hey, you're getting to the top of your budget. You're close to you utilize 20% of this section. So I think having one of those and, having those alerts is a constant reminder to keep those habits to reach those goals that you have in the future.
Great. Well, before we take questions and as we wrap up, let me ask each of you, is there one piece of advice that you could give to people for financial security? What would that advice be?
I would say start an emergency fund. because things are always going to happen. But knowing that you have a pool of money reserved for unexpected expenses, like a flat tire, car repairs, just gives you peace of mind to think about your other assets and income a little bit differently.
I would say building very strong foundation, and know what you currently have. So you know your employee benefits, your long-term disability, your life insurance, your emergency fund, knowing all of those pieces, making sure that you're paying off the high interest debt and building those savings on the side. And just having a very strong foundation, because you can do all of this investing and retirement planning, all of this, after the foundation is in place. It's like building a house. You want to make sure you have the foundation before you start building on top of it.
Abby stole mine, so I'll move on to just say that I think that it's also very important to pay very close attention to your bills and your outflows as well as your income. Sometimes it's hard to keep track of everything that goes out of our accounts, but it's very important to kind of make sure you check your bank statements, make sure you kind of keep a close eye on what's in and out, because things can sneak up on you and then all of a sudden you've spent $500 on God knows what. So
Okay, very good advice. Thank you. So Jessica, were you ready to open things up for questions from the floor?
Absolutely. So we do have a couple questions. I'll share the first. Can the panelists share how they might navigate stepping into investing while paying off debt? Should you prioritize paying off certain amount of debt before maximizing your investments?
I tend to, sorry, Justin. I tend to, I've listened to financial YouTubers, and one that is very popular and everyone who knows is Dave Ramsey. I'm not entirely on board with his approach, but I do think that high interest debt, credit card debt, personal loans, these things should be paid off almost before you start investing, because there's nothing that kind of tanks your financial situation like escalating debt. So those things have to be tackled with priority. Things like mortgages, low interest car loans, they're not horrible. I don't think you should really keep a $60,000 loan for a car, but each their own. But I think that pay off high interest debt before maximizing investing is my take.
I think knowing the difference between good and bad debt, you want to look at it in terms of interest rates and what's the opportunity cost in exchange for paying off that debt. If you have a 2% mortgage, keep that forever. Do not, pay the least amount and keep that, because you're never going to probably see that again. It's very rare. And pay off those credit cards first and tackle the amount that's manageable. If you have a credit card that's $10,000, $500, and $5,000, if you can get that $500 one paid off, that mindset of having that paid off is going to help you accomplish getting the larger amounts paid off. I like to look at it kind of as a good number, 6% interest rate. If you have below that, prioritize investing. If you have above that, you want to kind of tackle the high interest first.
Yeah.
Great. Oh, go ahead, Justin.
No, I think Lucas and Abby kind of answered the question. If I were to add anything, it would just to understand the difference between what your needs are and what your wants are, right? And as you evolve, you'll become much better at managing your money by avoiding unnecessary spending, but also tacking on large interest rates. I think about credit cards normally with 25 to 30% of interest, right, relative to a small purchase in the grand scheme of things. So
Great. Thank you all. The next question is, what are some common budgeting mistakes people make and how can we avoid them?
I think Abby kind of covered it really well, but it's my personal view is under assuming what your expenses are. So if you go into, your budgeting process and you think, oh, I spend $100 on food, and it turns out it's more like $2, underestimating what you actually spend is probably the biggest mistake that I've seen.
Great. How can families plan for financial milestones such as buying a home or saving for a child's college? And how can you prepare for those unexpected challenges?
Yeah, I would say I think it goes back to itemizing your balance sheet and then just delegating a job description. So, in a goal of buying a home, I would say, what is the time horizon? Is it going to be something that's going to happen in the next year or 2 years? And if that's the case, I would say you don't want to invest that money. You probably want to look at a money market account or a high yield savings because it's going to be relatively liquid. And in terms of a college planning, I think there are a lot of state-sponsored plans that do a really great job. Like in Connecticut, Fidelity sponsor is the 529 plan sponsor. And some of the things to look into is the state tax deduction that you can partake in if you're a state resident. So go on your state's website, see who the administrator is, and again, start compounding those dollars early.
Great. We're going into the retirement area next. What are the differences between retirement accounts like 401k, the IRA, 403b, and should you open an IRA if you have an employer offer a 403b?
Something
So-
that sorry, Lucas.
No, go ahead. It's go hard.
Something that I always look at first with clients is what their options are in terms of Roth versus traditional. And if they have the option to do Roth and they're younger, looking at that through their employer plan and what their match is. So if, depending on what your match is, if you only have the traditional option for retirement plans, you may want to contribute up to the match and then do an outside individual Roth IRA so that you can take advantage of those tax advantages when you're younger. And then to, really with retirement accounts, just what your employer offers. So if you have a 401k, it's just going to be a private or public company versus if you have a 403b or anything like that, that's going to be your public sector. So like if you're working through the school system or in a nonprofit or et cetera.
Great.
I think it's also 401ks, 403bs have kind of predetermined options. Your employer will set them up, where in an IRA, it's a lot more freeform. You can invest the way that you want in these accounts. So I always like having an IRA just because I have the optionality to buy the things that I want versus being stuck with, the limited selection in 401ks or 403bs.
Yeah. Lucas, this is also a question for you. You touched on retirement. How can Social Security and pensions fit into the overall strategy of retirement?
I think they're great augments. I don't think that you should, base everything on the assumption that you'll have, a certain dollar figure from Social Security or a pension. Pensions are kind of going away. They're not as common as they used to be. And Social Security is, right or left, there's some stuff going on with Social Security right now. So, it's one of those things where it's hard to have a guarantee. So I think it's one of those things where it's a nice extra, but I don't know if you should rely 100% on something like that.
I tell my students to imagine to plan as if there is no such thing as Social Security. For one thing, if people who are my students are in college, they're probably going to get fairly good salaries. The amount that you get from Social Security is not that much. I mean, you do get some, and it's kind of a nice boost. The other part of Social Security, and Lucas was hinting at that, is that the country is facing massive budget deficits right now, and what's driving that are mostly things like Social Security and Medicare. And at some point, the government is going to have to figure out how it's going to deal with that. My guess is that it's not going to be by reducing benefits, especially not benefits to people that are near retirement, but it may involve changes to benefits of people who are young, who are far away, and so are not as politically sensitive to what might be changed in Social Security to try to balance the federal budget.
Going into the retirement still, would life insurance also be a good idea for folks and planning their needs with that? Is there a provider that people use as well personally that they would like to share?
I think with anything else, life insurance is a tool. And so as fiduciaries on the call, I would say, you're giving every dollar a job description. So life insurance is primarily meant to replace human life value. Now, there are different types of policies that do exist. And one thing that I would look at in shopping for life insurance is the type of carrier, and whether it's a stock company or a mutual company, because I do think that those factors play into the bottom line. But I would say for most people, um, you know, they have options through their employer in terms of covering at least 1 to 2 times benefit. But look at your household from a needs-based objective and say, hey, is this something that I'm looking to commit to long term? And like Abby mentioned earlier, there are programs that exist where there's cash that grows in those policies. But let's say you don't have a specific need to replace a spouse's life for your life. There are other alternatives that can give you a better ROI or rate of return on your dollars.
All right.
And
The whole life, go ahead, I'm sorry.
No, go ahead.
Oh, I was just gonna say on life insurance, I think the most important thing is that core covering your risk piece first, because at the end of the day, life insurance is there to make sure that if you're not there tomorrow, your loved ones are covered.
Mhm.
And I think the biggest detriment to people's plans overall is not thinking about that risk actually happening and making sure that you really have the right amount in place if something was to happen. And you can care for your kids, you can pay off the mortgage if for your spouse, so you can care for their education in the future, give them a good foundation if something really was to happen.
Mhm. Yeah, there's an argument that you should never buy whole life because whole life is just bundling an investment with term life insurance, and you can do better by just investing the money as an investment separately and buying the term life. I think it is true that historically, at any rate, whole life was, I think, valuable because it provided kind of an automatic way for ordinary people to save at a time when they didn't have a lot of access to financial instruments like that. I can remember when I was a kid, the insurance man would actually come to our house to collect the insurance premium, and so this was a way that you would routinize or mechanize your savings. But I think that we're past that stage now, and you're much better off directly investing in something like an IRA rather than buying whole life insurance.
That goes really well into our next question of what do you do when you're starting your retirement later in their life, and how can they maximize their contribution to boost their funds?
Yeah, I would say a great place to start is your company's benefits package. And so I always advise all our clients to at least contribute up to a company match. And I would view that as free money, if you will. And then there's a concept called a vesting period. So depending on how long you're with a firm, you can either keep those vested benefits, or if you leave before a certain time, you can lose that. So just be mindful of your contract. But I would say definitely the 401k, and normally there are funding limits, so you can delegate a specific amount of dollars per paycheck towards that. In most qualified plans, the caveat or the thing to think about is you'll get a tax deduction on the year in which you contribute, but you're actually just deferring taxes for later. So the question is, do you want to pay taxes now or do you want to pay taxes later? And I think Lucas had a few great points on Roth options, either through a Roth IRA or even a Roth 401k or through your employer.
It's also, most of the retirement accounts that we touched on, they have catch-up options. So if you're, there are contribution limits. I think it's 23,500 for 401ks, 403bs, and 7,000 for IRAs. If you're over the age of 50, you have an additional amount that you can contribute. And then if you're over the age of 60, I believe there's even more that you can contribute. So that also is a benefit.
Think too, for starting retirement later in life, just really sticking to that goal and contributing the most you can, but also just looking at strategically, Social Security, if you defer that period of when you start taking it, you can get a larger benefit. So you want to be strategic. If you could pull from those qualified accounts earlier on and defer it, Social Security until as late as you can, it's about a 7% increase in what you get paid in benefit every month. If you defer it every year. So it's about 7% per year of deferral.
Yeah, great point, Abby. And that number at 70, so Richard mentioned this earlier, in retirement planning, it's really important to build a bridge to Social Security. So we're huge fans of having equities be the foundation of that bridge. But let's say you defer Social Security to age 70, that's a $58,000 annual salary that you're drawing on for the rest of your life. So hopefully it doesn't run out anytime soon for us on the call, but deferring out Social Security is always a better option because you'll have more income over your lifetime.
You want to be very strategic of where you're pulling from and location based on that. Because when you're in that retirement distribution phase, the overall allocation of your funds is not as important as the overall location, because you want to think about how you're going to pull from them every year, based on equities versus qualified accounts versus non-qualified accounts versus, Social Security's pensions, all of that all fit into that. And then how you're leaving the legacy, what kind of accounts are better to leave off to your kids in the future.
Great. Thank you all. We're going back to the beginning a little bit on this next question. How much should people be putting for their budgets in their emergency savings? And what are some steps that one can use to grow it quickly?
I always think 3 to 6 months is the standard. 6 months maybe if you're more anxious about these things, or if you have not a super stable income, whether you're hourly or you're a contractor or anything like that. And if you're more comfortable with 3 months, you can do 3 months. But I think once you get below 3 months, that poses a risk to you and your family if you were to lose your job suddenly or something were to happen like that.
I think 3 to 6 months is a great rule of thumb. I always ask clients, what makes you be able to sleep at night? Based on your risk tolerance, what feels good. If something was to happen tomorrow, how much would you want to have in the bank? And I think biggest, mistake people do make is making sure that your emergency fund is located in something like a high yield savings account so you can take advantage of that free growth.
Awesome. Abby, people are very curious about the budgeting app that you were referring to. Could you name that app that you use?
Yeah, I use Rocket Money. I think it's like $3 a month, and it just sends me alerts every time I reach the top of that budget, and it's very helpful.
Great. And then we'll get to the last question, and this last question is, what are the differences between stocks, bonds, mutual funds, and ETFs, and how would a beginner choose which ones to include in their portfolio?
Yeah, great question. I'll let Lucas handle this one because this is a common one, and I think a great starting point is actually your work 401k plan or your qualified plans. So I'll let Lucas take the lead here.
Okay. So I'll start with stocks or equities we've been talking about. It's essentially a piece of ownership in a company. So if you buy one share, you have one stock of, say, Apple, which means you own a certain portion of that company. It appreciates in value or decreases depending on company performance. Bonds are debt, essentially. It's a way to loan companies or municipalities or the government money. So when you talk about a treasury bond, that's you're essentially lending the government money in exchange for an interest return that you will get paid back. Mutual funds, there are a ton. I think there's actually more than the actual amount of stocks in the stock market. But a mutual fund is the basket of stocks. So we talked about, I think Richard mentioned the S&P 500. That's if there's a mutual fund option out there. There's a ton of them that has the 500 largest companies in the U.S. There's also total market mutual funds that have every company, and there's tons. I could go on and on. But the difference between them and ETFs is that mutual funds are valued once at the end of the day. So if you own an ETF, there's no price fluctuation. You just get a number at the end of the day that says this is the price. ETFs are functionally the same thing, but they trade intraday. So you'll see the price fluctuations day to day. There are some tax advantages here or there, but essentially those are the two, or the same thing. If you're a beginner, as Justin mentioned, in your company 401k or 403b, there are options. Usually they're mutual funds that vary, their target date funds, or there are, a large cap, a small cap, et cetera, et cetera. You can pick there. If everyone doesn't know, Vanguard is like one of the largest asset managers on the planet, and they've got, mutual funds and options for everybody. I would start simple. I would do, a broad diversified all market index fund or a mutual fund, whatever's easiest for you. If you go to, one of the big three, Schwab Fidelity Index or Schwab Fidelity or Vanguard, you can just search for, mutual funds, and they have tons of options that you can pick and choose at your discretion.
What should people do? Oh, sorry.
I was just going to add, when you're looking at mutual funds and ETFs and such, you really want to look at the embedded fees and what they're going to cost you. ETFs can be more affordable. There can be a lot less fees associated with it, while mutual funds can have a lot of embedded fees that you're not seeing that can take away from your growth. So you want to be very cognizant of that.
Great point. Thank you.
You all have mentioned 401ks, and somebody is also very curious about how they can prepare for financial security if their employer doesn't offer a 401k or a retirement package. What would you guys suggest?
Yeah, so I would say there are traditional individual retirement accounts or IRAs, and that can kind of work in a similar way as a 401k. Now there's not going to be a match because it's an individual account, and vice versa. You can start a Roth IRA if you're within the income thresholds, and that money grows without taxes and comes out tax-free. So it goes back to optionality on, do you want to pay taxes now or do you want to pay taxes later? And let's say you're a business owner and you don't have employees and you're starting out. There are retirement plans like SEP IRAs or simplified employee pension plans that allow a higher contribution and deduction amount. So I think it depends on your life stage, what you're doing for work. But I think those are three great reference points to start out.
Great. Well, that ends our Q&A session and also our panel for the day. Thank you all for your wonderful insight and your help. This has been an incredible panel. Thank you, Richard, for moderating as well. For all you Huskies attending, please be sure to check out our UConn alumni webpage, where you can find out more UConn events and also get more webinars like this as well for free and figure out when they are coming up next. But thank you all for joining us, and I hope you all have a wonderful afternoon.